Hello and welcome to Commodity Champions. I'm Manisha Gupta. Well, copper is trading at a 6-week lows with sentiment cautious as most Asian markets remain shut for the Lunar New Year. Prices are down nearly 15% from January's record highs of $6.5 per pound. Well, combined inventories across COMEX, LME and the Shanghai Future Exchange have surged to a 21-year highs at over 1 million tons. In precious metal markets, in the meanwhile, gold has extended losses, slipping below that $5,000 an ounce mark. Silver is also under pressure. This is amid thin liquidity with several Asian markets closed. However, it's the crude oil price is holding steady as the US and Iran hold second round of talks. Geopolitical tensions remain elevated after Iran conducted maritime drills in the Strait of Hormuz, while the US is deploying a second aircraft carrier to the region. Joining us now on the show is Hansen. He's head of commodity strategy at Saxo Bank. Hi, thank you so much for joining in. I want to start with metals first. And while the Chinese markets are shut, it's a truncated week for US as well. But with contradicting fundamentals coming in for copper, where on one side, the structural long-term demand from many consumers is still on. But on the other side, the kind of inventories, smelting, which the satellite records show is at a decade low as well. How are you reading all of these signs?
Well, good afternoon. Basically, that we once again have this mismatch between short-term developments and the longer-term picture. The short-term, as you mentioned, we're seeing inventory levels rising across the world, hitting a million ton on the exchange-monitored side, and there's probably more as well off exchange. So that's basically leaving us with an amply supplied market in the short term, weighing on prices and thereby also pressurizing traders and investors who have been buying into the long-term prospect. And it just once again highlights the commodities are not equities where you can buy today and expectations of future growth. You have to wait for the supply and demand situation to provide the underlying support. And right now we're not seeing that. That's why we're seeing some long liquidation. I'm not selling into this market. I'm purely just seeing long positions getting out and just getting to the sideline, waiting for the rebound, and which I believe will materialize over the coming months, especially next month. It's interesting to note how China behave when they come back from the holiday.
What's your sense then on the copper prices for a longer term? As you said, you're not selling and the long-term story does still look lucrative. Are we looking at those all-time highs coming back in yet again? How would you look at the prices in this year, the range that is?
I think we've probably seen the highs for this year already now, simply because that surge we saw in January was similar to what we saw in silver, completely unsustainable and unfounded. And that basically means that is now a bit of a ceiling for now. But even coming back towards those levels would generate quite a strong return on an annual basis. So I think for now the structural long-term outlook remains supportive. And that basically means we've probably seen the highs this year, but further highs could be expected in the coming years, simply to entice miners to work flat out to produce the copper that is required for the electrification and the energy transition.
How would you also look at silver prices? And I mean, as you mentioned, it's been a roller coaster ride onto this one. Most people believe that it is China who really played it both ways. How are you looking at the fundamentals herein? Because it's not just fundamentals. There's a lot of money, speculative movement, investment buying, all of that supporting whatever the prices did.
Yeah, silver has been suffering from the fact that there's been a lot of social media groups just calling for silver squeeze, the end of paper silver as we know it, and prices going to the moon and so on. I hate these kind of comments because it just distorts a market and you forget to look at fundamentals. Yes, there's no doubt that the physical side is tight right now, both in China and also in the US, if you look at the exchange monitored inventories. But what we tend to forget is if there is an action, there's also a reaction. And the reaction is the slowing demand from industrial users simply because prices becomes too high, above $100. We have increased supply of scrap. Just a small anecdotal story here from Denmark, Manisha. We're a small country, 6 million people, but 4 tons has been handed into to scrap dealers in the last 3 months alone. That's just in Denmark. And if you look at the global supply deficit this year, estimated to be around 2,000 tons, there will be supply coming into the market from scrap in the coming months. And I think that will help balance the market, and that basically will remove some of this focus on on these so-called experts looking for prices to go sky high.
Ol, what's your sense? How are you looking at gold and silver, both of those prices performing for the rest of this year as a range?
I prefer gold, as you can probably hear from my comments here, because gold is a monetary asset. It basically, whether the price is 5,000 or 10,000 doesn't matter. It is really a question of how much you're prepared to pay for a metal that you store for safekeeping. While silver has not got the same luxury, because there will be an impact on the industrial side. So I think the gold market is consolidating right now. I think the consolidation, we need to be patient here, because it could take probably longer than we anticipate. But as we move deeper into the years, somewhere between 5,500 and 6,000 an ounce, I think is still achievable. And with the gold-silver ratio return to the long-term average around 70, that would take silver up closer to 100, but not above.
Ol, how are you also looking at the energy as a market, with a couple of those important, interesting conversations between US, Iran, US also leading Ukraine and Russia conversation is what the street is looking at. Are you also looking at that, or are you looking at demand supply numbers?
I'm looking at the US midterm election. I'm looking at a president which is under pressure. I'm looking at a US consumer who doesn't really care what's happening on the other side of the world, especially in Iran. They're more concerned about the price at the pump. So call me a cynic, but I think what we're seeing right now is grandstanding from both sides. There's a lot of military assets in the Middle East right now, but I just don't see any escalation that leads to a disruption in supplies, and with that, surging energy prices. So if that turns out to be the case, then 70 will be the ceiling in oil prices for the foreseeable future. But of course, we need to see how things plan out. I might be completely wrong, but I'm just a little bit cynic here, looking at the US domestic situation as a reason why we're not going to see any escalation. So with that in mind, we're still stuck here in the 60s. OPEC are discussing perhaps increasing production again from April. That will add some additional supply. So with that in mind, again, just like the other metal or the other commodities, as we have a long-term bullish outlook. We think we are in a structural bull market, but at the same time, we need to wait for the supply and demand balances to underpin those movements. And I think that potentially could take us at least into the second half, or maybe early next year, before we start to see that play its part. And from that point on, we could see oil prices move higher as well.
Fair point. That's so plenty to watch out for the international markets there. But as always, Ol, thank you so much for joining in and making it a very crisp conversation on all of those commodities and your expectations therein. Well, let's delve